All right, today we are digging into a financial product that honestly, on the surface, seems to promise the impossible. We're talking about an ETF with a yield so high, it's making everyone stop and ask some pretty serious questions. The fund in the spotlight? It's ULTY, the YieldMax Ultra Option Income Strategy ETF.
And when I say the yield is high, I mean it. Depending on how you do the math on its weekly payouts, you can get an annualized yield that rockets past 100%. Yeah, a number that big, it's going to generate a lot of buzz.
So that leads us to the big, obvious question. And really, the whole reason we're doing this explainer. Is a yield like that for real? Is it sustainable? Or is it just a massive red flag? To figure that out, we've got to pop the hood and see what's going on inside. Okay, let's dive right in. To really get a handle on the potential opportunity here, and more importantly, the risk, we first have to understand what ULTY actually is and how in the world it's generating that kind of income.
So ULTY isn't your granddad's stock or bond fund. It belongs to a special category called an option income ETF. Its main job, its whole reason for existing, is to generate cash flow. And it does that by using some pretty complex option strategies on top of a basket of stocks. You can almost think of it as an income-generating machine.
So let's take a quick look at what it's made of. ULTY holds almost 100 different stocks, and that includes some pretty speculative, high-flying tech names like Palantir and IonQ. But it does keep about 20% of its assets in a government bond fund, kind of like a safety buffer. And get this, it pays out its income every single week. The trade-off? It charges a pretty hefty fee, around 1.3%.
Okay, so where's all this money actually coming from? Well, it's not just one thing. The lion's share of the income comes from the cash it collects by selling options. That's the premium. Then, a smaller slice comes from the regular dividends paid out by the stocks it owns. And finally, another piece comes from the interest it earns on those treasury bonds. It's a three-pronged attack for generating income.
So now that we have a feel for how it works, let's build the case for ULTY. Why are some investors getting so excited about this thing, especially right now? This is the thesis, the bull case.
And the argument is pretty powerful. First, obviously, that insane yield paid out weekly. That's a massive draw for anyone looking for income. Second, with the share price down in that $5 to $6 range, your yield on cost is just huge. The fund is also spread across a bunch of stocks, which is nice, and some recent tweaks to its strategies seem to be helping slow down the price drop, giving some folks hope that it's finally found its footing.
But you know how it goes. An incredible reward almost always comes with incredible risk. So now it's time to flip the coin and look at the other side, the antithesis, the hidden dangers lurking inside ULTY.
And really, it all boils down to this one fundamental trade-off. It's so important to understand this. ULTY offers you the promise of extremely high weekly income, but the price you pay for that promise is taking on a significant risk of losing your initial investment.
The single biggest risk, the monster under the bed here, is a concept called NAV erosion. All that means is the fund's share price goes down over time. And with ULTY, that drop has been, well, dramatic. It's fallen from a high of around 20 bucks all the way down to where it is now. So for those early investors, that huge yield was completely wiped out by a massive loss in their original investment.
And the risks don't end there, not by a long shot. A lot of the stocks it owns are really speculative. Its income stream depends on the market being volatile. If things calm down, the income could dry up. Those high fees are a constant drag on your returns. And you have to ask the ultimate question, are these giant payouts real, sustainable income? Or is the fund just handing you back your own money while the share price collapses?
So, we've seen the good, the really compelling thesis, and we've seen the bad, the very real antithesis. So let's try to synthesize all this. What's the final verdict? And who, if anyone, should even be thinking about an investment like this?
For anyone who's still intrigued, you have to be smart about it. This is not a bet the farm kind of investment. At most, you'd consider it for a very small, speculative piece of your portfolio. You'd have to watch its share price like a hawk, think really hard about what would happen in a market crash, and maybe most important of all, you need a clear exit plan before you ever put a single dollar in.
So let's just spell it out. Who might this be for? ULTY could make sense if you're an aggressive investor hunting for maximum income, you have a stomach made of steel for risk and volatility, and, this is key, it's only a tiny part of an already solid, safer portfolio.
On the other hand, if you need to protect your money, if you can't handle huge price swings, or if you're a retiree who needs income you can actually count on, you should probably run in the other direction.
You know, analyst Tony Hicks really nails it with this quote. He says, ULT is compelling for a slice of your portfolio, not for everything. It perfectly captures that idea that, yeah, the low price might offer an opportunity, but it comes with huge, flashing neon sign caveats that you just cannot ignore.
And that brings us right back to where we started. You've seen how it works, you've heard the strong case for it, and you've seen the very serious case against it. At the end of the day, the decision has to be yours. For your own goals and your own comfort with risk, is that absolutely extraordinary yield worth the very, very real risk to your money? That's the question only you can answer.